it's just
one thing to the next. Yeah, just
always running,
relax,
always running.
All right. Thank you so much for tuning in to Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. Now, most of us, we go out there and we always want to invest like the 1%. Well, what if I told you you don't want to? What if you want to invest like the 0.001%? Well, that's the reason why I have this next guest on. He is the author of Investing Legacy, How the 0.001% Invest. He is also the CEO and co-founding partner at HRN, CEO and CIO, Chief Investment Officer of Dandrew Partners Capital Management, where they work very closely with privately held assets, including real estate, institutional-based credit, equity, venture fund creation, management, and private direct investment structures, working with hundreds upon hundreds of family offices doing certain specific exclusive deals. We're so excited about having him on. Please welcome my next guest, the one and only Salvatore Buscemi. How you doing today, my man?
How are you? Christian, it's great. Good to see you. Good to talk to you again. It's a pleasure and a privilege. Just looking at what we were talking about last week, I think this could be a very killer episode for us. What do you think?
Oh, definitely, man. And I'm excited about it because one of the things you mentioned, and we were just riffing on just before we got on this podcast, about just the things that the middle class don't have access to, and how the 0.001%, how they totally think differently. And I know this is going to start big, but you mentioned this in your book, Investing Legacy, which is really, really incredible. I had the opportunity to read it. But Salvatore, real quick, what do you think the middle class are getting tremendously wrong and don't even have access to some of these exclusive deals?
Well, I think what they get wrong is that a lot of people who are in the middle class today are really the 1%, right? I mean, we're talking about the difference between the 1% and the top thousandth of the 1%, which is the top decile of the world as far as society and investing is concerned. And the problem is with the middle class today is that they're speculators. They're speculating, and they don't understand how to assess risk correctly. And obviously that has come down. That a lot of those speculative investments we've seen sort of die off over time pretty spectacularly. Even though Bitcoin has had some sort of a run up, we saw FTX collapse. We saw a lot of people that were putting a lot of money into on a speculative get rich quick basis, especially the middle class. They started getting wiped out on it. And I think the problem is that they don't take time to really do two things. Number one, if they really want to become a professional investor and they really want to build a legacy for themselves, they have to build a formidable network. That means if you're a doctor, you have to leave your doctor. It's sort of like what is it when they tell you, like, when you want to change your lifestyle, you have to like change your friends or change who you're around with, whether like you're trying to lose weight or you're trying to stop drinking. I think the problem is that people get too caught up in the herd mentality, and they have one guy that's knocking it out of the park supposedly in one stock, and they're all taking advice from each other, which is usually not the right advice, but it becomes speculative, and they're following the person who's perceived to be the smartest, but they put a lot of money into that because they're just lazy and they don't want to do the work themselves. It's incredible. They don't want to. It's almost they don't have the time to do it, but. It's almost like they're swinging for the fences intentionally because they know that over the past 14 years we've had zero interest rates, so that's robbed them of their savings. And if you look at low interest rates, that's really a tax. And there are things that have affected the middle class for someone who's making less than around $300,000 a year. That is not affecting people in the much higher income strata. I wouldn't say income strata, but people who own a lot more assets, principally privately held assets.
Let me ask you this, because you've been in this industry many, many years, and I love what you said, because you mentioned this in the book. It is about those private access, those exclusivity, environments where not everybody's able to get access to. And like you mentioned in the book as well, and you mentioned in other pieces of content you talk about where the high, ultra high net worth individuals, right? They think about different. It's more status, right? But I want to ask, before we dive into that, it's more of, Salvatore, at what point in your journey did you understand the impact of network? But then not only the impact of network, but also how did you navigate it to be able to get into those big arenas, to be able to network with those exclusive individuals and the partners that you have now?
Probably the most, and I talk about this in my book, Investing Legacy, how the 0.001% invest. And I think the biggest lesson I've ever had was that my grandfather, Thomas Dandrew, was a hotelier, and he was very, I learned a lot from him, right? We would always go out to, Sunday, lunch, or, after church, we'd go out to breakfast with him, and he would impart his principles. And really, he was always saying that your network is the most important thing in your reputation. And I took this to heart because when I was in school, in college in New York City, I was kind of miserable because I was pre-med at the time. I was biology and chemistry. I was a rower on the team too, so I was pretty busy, but it was hard because between junior and senior year, I read a book called Confessions of a Medical Heretic. Now, this was back in 1992 I'm talking about. The book was written in 1977. And that sort of formulated into me it sort of made me kind of anxious as to where I was going to go. And I was working with this doctor at the time who was a famous orthopedic surgeon for the Knicks, and I would go down over to Beth Israel Hospital where there was a total knee reconstructive surgery center. And I passed out holding a fibula about a couple months in the cadaver room. And I said to myself, I'm not really doing this for the right reasons. I'm not really into it. And it made senior year kind of hard for me. So I went through the motions and I continued with the internship, only doing research, right? So I was doing a lot of library work and not really doing too much in the ER, although I was participating and watching these guys with hammers just whack knees and it was making me sick to my stomach. And after I graduated, the doctor I worked for, he knew something was up, and me being younger at the time, just graduated, I didn't have the heart to tell him that I didn't want to go to medical school because this guy had championed me. He had the perfect life of something that I would aspire to have that nobody has today unless you're in plastics. And that is, he had the Aston Martin, a beautiful wife, a house in the same building as Gloria Vanderbilt on the Upper East Side, and all of this stuff. And he was really championing me hard. And I basically had an hour-long conversation with him one day, and I remember it was when the first cell phones came out. I'm on the corner of the street on East 10th Street, and I'm talking to him, and he's like, hey, I haven't heard from you in a while. And it was an hour-long conversation, and he finally said, you know what, Sal, I agree with you. You're a hard worker. By the way, my brother just made partner at Goldman Sachs. I think you should talk to him. And at that point, that's how the reputation and the network started to grow. And that was probably the most important lesson of my life because at that point, it was really what people thought of you. And so many, like your work ethic and your character and everything. And that's really gotten me kind of far, especially when I was trying to raise money at the age of 29, which is kind of young. I was able to get $30 million from a Park Avenue investment manager because I was the only one that said, hey, we have to short the housing market. Here's how we're going to do it. And we basically became the kitchen sink for Bear Stearns, and then I replicated that same thing in the western United States, in Las Vegas and Southern California, where there was a lot of commercial distress. And if it comes down to that, it's really the network. And a lot of people don't put a lot of time into building relationships. Like you and I were shooting the breeze before this, and we always do. It's like, yeah, Miami's a great life. I live down here. You can tell by the chandelier in the background. I love it. It has a different vibe here. It's not like New York at all. It's almost like a 24/7 city. But the network here is just incredible because I came here and I moved here specifically to build relationships that weren't in New York that I had already, but to rebuild new relationships down here because Miami's really become sort of like the melting pot recently. There's people who have displaced themselves from California to move out here. There's a tremendous amount of wealth and affluence, but there's also a lot of smart people here too who are more aligned with what we're doing, and that book is sort of like the dog whistle for them. So when I go to Palm Beach, I hand that out like cookies. People read it, they get back to me. And, it sort of formulates building a community because that's what people want today is that interactivity. And you're on my email list, so you see my emails, you see everything that goes out, you see pictures from like the black tie galas. That interactivity people like. People want that communication. And I go out of my way, and I've made this clear with my partners, and they love it, is that we interview the CEOs. Some of these guys like to do it the old school way in the 90s where they, send out these huge letters. And I used to send out these huge investment letters, Christian, but nobody would read them. And then I recorded it on video, and then people were like, it's boring. So now I'm like, we got to turn this into a way where we get people's attention because that's really the most valuable thing today. Is getting people's attention. As a professional podcaster, you know that, right? And when you're able to do that, it works really, really well. And that's what we're trying to do is just to keep the attention of all of our member families so that they understand this is what we're working on. There's always going to be good things. There's going to be some bad things. We haven't had any bad things, thankfully, knock on wood. But we tell people why we haven't had any bad things. And we're very clear with that. And we do a lot of repetition and refrains that we only invest in world-class companies with pedigreed operators or sponsors or founders or CEOs who've been through this before, not first-time people who are looking, for an opportunity on Shark Tank. And, not to go too much further on it, but if you look at Shark Tank, that's a great show as far as like the microcosm of like venture investing or private investing in America today. people don't have the network. They have an idea, so they go groveling on national TV for $300,000. Does that make sense?
It does, and I see the power of it that has evolved over and over and over. You've seen in every deal that you guys have done, at Dandrew Partners, it has been through your network and your ecosystem that you have established and the relationships you've built. And you go very heavily in your book, which actually I want to kind of pivot a little bit. I'm so glad you talked a little bit about your investment thesis, because you actually talk a little bit about the filtering process. If you guys are going to harness your ecosystem and deploy and infuse capital with this company, whatever that deal may be, whether it's different alternative investing, private equity, VC, direct, whatever it may be, you talk a lot about kind of your criteria, and it's actually very heavy. And I thought that was actually really a breath of fresh air, if you will, in regards to your investment thesis. I'd love for you to just talk a little bit about that, where you talk, obviously, the kind of quality that you're looking in regards to the founder, what they need to have, several years, and other different instruments and thesis. Please share that a little bit, because I thought that was just really, really remarkable.
We have come to an early, when we set up the multifamily office that does a lot of venture stuff in life sciences, it was mostly real estate investors who had a gateway drug to life sciences, but through philanthropy, and they were screwing it up. And they were giving to these foundations that had high expense ratios and made them feel good, but only 10% of the dollar really made it towards its intended purpose. And we found out that our biggest strength was our network. And what it was is that a lot of these deals I had been doing with Dandrew Partners beforehand with a few cowboy families who trusted me. But I went out there and I said to them, look, we're not going to invest in anything in venture that doesn't fit these two things, at least two, okay? And this is important, but people take it for granted. We bet on people. All risk is human. So first, if it's a founder or a real estate sponsor, we'll start with venture first. I want them to have multiple exits. We're doing a deal right now where it's going to be it's called Thrive Bioscience. It'll be the founder's 15th exit and possibly his 8th unicorn. These are people you want to invest into. Now, there's also smart money too. And when you look at a venture company or any sort of entity that's private you're investing into, the cap table or the other investors is really the soul of the asset, because that tells you if this guy has a good network or not. And when you see other larger leading name brand families who have a specialty in this going into it, then that adds a tremendous amount of conviction. And so for us, then we know that there's other smart people at the table and we can compare notes and gossip and everything. Because the definition of risk that nobody really wants to talk about is everybody has a quantitative approach and they'll come up with all sorts of things where they talk about negative beta and all this stuff. But really at the end of the day, it means if anything goes wrong, who are you going to point the finger to? And that's really what it comes down to. They're going to point it to you because you made the bad decision, or are you going to point it to the CEO because he didn't know what he was doing and something happened personally in his life? And it becomes an issue. So when you have a CEO that's had a tremendous amount of experience, there's also a tremendous amount of emotional intelligence too. You can have very, very smart people, and I liken it to like a V12 Mercedes engine. But if they don't have the emotional intellect or the emotional quotient to be able to transact in a way or deal with life situations, then really they don't have a strong enough transmission. If you put a V12 in a Honda transmission, what's going to happen? It's not going to work, right? The engine will blow up or the transmission will just drop or just, who knows what will happen. I'm not really a big car buff. But it'll never get to its intended recipient, which is the rubber on the road, as far as the traction. So when you look at these these operators, I want them to see that they've done this before. And moving to Miami has become a tremendous tech center, if you will, post-pandemic, and although after SVB and that whole Silicon Valley Bank debacle has sort of slowed down a little bit, there were a lot of people who had very pretty pitch books, cool logos, some board of advisors, but that really just, that they weren't really doing anything. And, when you see through it all, it's just nothing but a great idea with a pretty pitch book, and I'm looking for the depth, meaning if there is another Silicon Valley Bank, if there is another pandemic, if there's another, just because it's extreme now doesn't mean that it's necessarily rare. And, if there is another 500 basis point hike in the markets, who am I going to want to be in bed with at that point when things go wrong? And I think a lot of people don't look at it that way. They look at it from what can go right? Look at everything that can go right. Well, this guy is smart. Yes, he's, turning 50 and it's his first, entrepreneurial endeavor, but he's got a great idea and a great pitch book. That's not enough for me. So by the time it comes to us, people know that we have to look at things, and we only look at first class opportunities. And that's how we do it. And in real estate, it's a little more, it's a little different than that. But because I'm sure there's real estate investors here who are looking to invest passively into real estate, we have a great track record, and we're very protective of the track record because of the fact that we follow 3 rules. Before it even gets to my plate, before it gets to the point where I have to actually look at it, I want a sponsor that's been through at least 2 economic cycles. First economic cycle, I guess you can say, going back would be 2008, and then one before that, probably going back, to the late 90s. That shows that they have the network and the conviction to be able to work through difficult issues, and they have the network themselves to get things loosened up quickly. I also want to see them put a meaningful sponsor commitment, co-invest into it. Sometimes you'll see them put nothing into it. Sometimes they'll roll fees into it if they're playing broker-dealer. We've all seen that game. But one of the things that I like to see is, put in a maximum amount. 5% is cute, 10% is thoughtful. Anything more shows complete conviction. And that's really what we're stating right now, is that some of the deals we do, the sponsor puts in, 30% or 40%. That makes me feel much more warm and fuzzy at night going to bed, knowing in the middle of a pandemic that there's a lot of bad things that need to happen before I or my investors lose money. And then the last thing, too, is an audited track record. I want to make sure that we get an audited track record as well. If your track record is so great, how come you didn't pay to get it audited? And this is, to us, it sort of gives me the creature comforts knowing, okay, now we can start looking into the numbers of the deal. Because before then, who cares about the numbers? If you're not dealing with the best in class, why would it matter? Don't even follow, and people do this, and investors don't understand this who are new to this game, is that, there's a lot of, that models function both in
and that's why I really wanted to, foot stomp on this, because I just thought that was so cool how you have these high hurdles.
And so when you look at it,
you are really,
you really need to know what to look at before, and you need to really have some sort of determined rules, a structure around it before you start taking other people's money.
It does, and filtering out majority of these deals, right, before they even land on your, like you mentioned, all the. And so I want to talk a little bit about that, and then there's the actual measurement of the KPIs.
Yeah.
What's the story behind the last 3 years of growth and 4 years of growth, et cetera, et cetera. I know this is probably very industry and contextual depending upon each industry and the margins and so forth. But is there kind of a methodology or the way you look at it in regards to when you're looking at the company and reviewing them in regards to their metrics, their KPIs, once you complete the first few steps?
Mm-hmm. That's diligence, and I think when we look into life sciences, it's like the swim lanes, it's like the efficacy, and there's many ways of looking of being able to translate that into a way that's meaningful on a comparative basis. However, because we are dealing with venture and we are dealing with things that are private, those KPIs are great to hit, and sometimes they get hit and sometimes they don't. I like to look at seeing how fast this operator has moved in the past as a proxy to see how fast he'll move in the future. So you could have any sort of pro forma KPIs or something in front of you, but that doesn't necessarily mean that those are going to get hit. So what is the backup plan then when it comes to this? Is what happens if these KPIs don't get hit? What happens if this doesn't go through as it's phase 2 trial? What happens next? And I'm always looking to see, well, what's the backup plan? What happens after this? How do we commercialize it? I think the KPIs are very good to look at, and I think when you're looking at more consumer-based businesses, digital online businesses, you look at those things differently. But what we're looking for is the growth and the efficacy, and really people noticing it, especially with one of our companies, Genius Biotechnology, based in Boston. They're partnering right now with Yale to manufacture their product. That's important for me. That's one of their, I wouldn't call it a KPI, but that's what I call a strategic partnership that's going to be able to bring them to commercialization much faster. And for me, it's what are the pieces that you're doing to move to commercialization much faster than anything else, and how is that being done in real time? And that really is more or less a function of a business plan and relationships than it is in something you can put on paper. And it's the same thing with real estate. Like, a lot of people overpaid for real estate because they were looking off of the pro forma because they didn't know any better, right? And the pro forma is really a lie. Let's face it. I've been in this business for many, many years, and I learned from the best. However, people still base it off of it. And I'm just looking at, okay, what are the things that are really moving the needle right now? And more often than not, it's relationships. Does that make sense? And if they have the relationships with Yale and Harvard and this, and they went there, and it's not just like they live in Boston, they're in Natick, or they're in somewhere in Cambridge.
Well, what I like about this
there's a
approach
working
is it's a
partnership there.
methodology
That's
that
what
you
I
can
like
apply
to see, because I know that
and
there
deploy
is going to be
effectively
a
with
concerted
each
effort
company, with
for
each
both of
offer.
them to
It
move
doesn't matter
forward on
what
it, because
alternative investing
frankly, it's a function
thesis
of
it is.
resources of both.
I want
and you're
to
dealing with
talk
this
a
high
little, because you've
caliber,
been in this
nobody likes to
business for
waste
20
resources.
plus years, okay, and you've been around the corner, you've been through all the ups and downs and so forth. Salvatore, you mentioned obviously all these pillars, these hurdles. This is your criteria, your methodology, right? How has that evolved since you first started to now? And what were that evolution that you started with to now?
It was interesting. I mentioned it in the book, and I had a pivot in 2013 because we were just coming out of the Great Recession. Rates were going low, okay, and values were going up. And as someone who's traditionally distressed focused in real estate, it sort of went against the fabric of my being to sort of overbid on something just to say that I would overbid and have the asset. And I was actually outbid by a bunch of doctors and dentists who had signature lines of credit or using their home equity lines, and they were outbidding me on what's called necessity retail in Midwest. And these things were trading at a 10 cap going back to Moses, right? And they were, if anybody knows about this, the more you pay, the lower the cap rate. And so they were bidding the equivalent of like an 8 cap rate. So they were going 200 basis points faster than I was, or over what I wanted to do. And I just, I honestly, and I had, it was just to me, and it was just, I had to bury the ego, and I gave back $19 million. And nobody likes to do that without putting a gun to your head, but it was sort of like, look, we got outbid. If we got into this deal, I would never have been able to get you out alive. This went against everything. And, basically it was a lawyer, trying to force me to bid up because he had already seen the proof of funds and everything. And he's like, well, what are you going to do? Give it back, son? I'm like, yeah. And there was a few expletives after that, but, just trust me that I was in full New York mode that day. And I gave the money back. And the money came back, and one of my mentors, and I was going through a little bit of a personal struggle with that life. I just lost my brother not too long after in 2015, very spontaneously. And I called one of my mentors in New York who I've invested into, and he has 69 IPOs and sales under his belt. He's close to 80, very wealthy, and he is one of the founding fathers of venture capital. And it was one of these things in my life where real estate wasn't really going anywhere for me at the time, because I'm, more of like a distressed guy and I need to show value rather than overbid, and look where that's getting people today. And I said, I'd really like to start a venture fund and start investing into some of the things you're doing. And he said, with his thick Persian accent, well, let's do this. And over the course of the week, I was able to get a lot done as far as structuring it. But it was that hard pivot where I learned that I kept to I had to keep to my guns. And I think a lot of people would have taken money from people just to make money, but they would have ruined themselves later. And this guy always told me to focus on quality. And that's why we have the world-class venture fund that I manage, and also, the multifamily office HRN, which has a lot of venture in it too as well. And if you go to hrn.llc or harlemrivernavy.org, you'll be able to see this and some of those names. We are in the midst of updating that. However, if you are on the website and you do want to, you can obviously go to sal@hrn.llc and send an email, and I'll get you on to the email distribution. But you'll see that we have a lot of world-class people that we work with because we've always attended to that quality. And if it wasn't the relationship I had with that one gentleman, I don't think I would have the partners I have today. I don't think I would have the success I would have today. Even, and some of the other things too. And even though we haven't done a lot of real estate, since the pandemic, because we were waiting for rates to go up and everything, to me that was an important skill set because I had to build on the salesmanship of myself to influence people to invest in something that nobody really likes to invest into. And that was sort of like an intellectual challenge for me because, it kept me from being depressed, sort of. I was still kind of upset and everything. But it really forced me to try to focus on, all right, here's the next challenge. Raise tens of millions of dollars, which is the equivalent of hundreds of millions of dollars, for life science companies, and try to get people's attention to do this who don't want to invest in life sciences because they don't want to be bored and reminded of high school biology and chemistry again. So we had to make it fun and interactive, but we were able to lever the successes of our CEOs and also the stories and their credibility in order to raise tens of millions of dollars into these deals. And the rest is history on that. And just recently, back in January or early February, we received news that one of our companies just received FDA approval for their personal defibrillation device. It's called a PED, and it's one of the hardest things to get from the FDA. This is a team that's 27 years old. There's a story behind this, but their father's a rock star CEO. Again, network relationships. And they were able to get an FDA device for the first mobile defibrillator. So think about it, all the unfortunate norms that are happening right now in the football fields, both in the professional leagues and also as it relates to high schools. You have a lot of these kids who are just going into cardiac arrest. Now every mom, coach, high school, brother, uncle is going to have one of these defibrillation devices that's really the size of one of your iPods that you can charge and use clear with your cell phone, and it'll be powered by your cell phone. If you're interested in that, I'm not. Again, I'm not a salesperson, but if you go to aviveaed.com or Avive Solutions, AVIVE, you'll be able to pick one
I
up
love
for
that,
yourself
and it was just because of that pivot that actually helped you integrate
to me, that's the massive impact that people make, because when you start pivoting towards that, you start looking at the impact with quality, then people start to get a lot more emotionally engaged.
Throughout your whole journey in a lot of different ventures, which is really awesome. I want to talk a little bit about how you mentioned in your book the paradigm shift in regards to how the 1% versus the 0.001%, right? And the 0.001%, like you mentioned, we were talking offline, they don't look to really add, definitely if it's like second generation or whatever, they're not looking to add another comma to their wealth, right? They're looking for status symbols, just in different way. Owning sports, owning Class A real estate. You mentioned that a little bit. Before we dive into that thesis, I want to ask, when you came to acknowledge that and become aware of that in your own life throughout your journey, how has that changed your investment thesis or your investment strategy, or maybe your perspective on how to deploy capital when you're partnering up with these ultra high net worth individuals?
The money always has a voice, and you have to give them the best product today. And the best product today isn't necessarily something that pays the highest return. It's something that they can brag to their friends about. We talked about this with sports. We're pivoting into sports. This could be world-class life science companies headed by people who are, for example, we have one that's headed by the 2018 Nobel Prize winner, Dr. James Allison, called Apricity Health. That is what sells, because that's something that people are not going to be able to get into on their own because they don't have the knowledge, nor do they have the network to get into that. So wealthy people are more, they tend to gravitate towards that more because there's a certainty there of execution, because they know that someone's there and they can talk about that at the breakers over brunch or tea to their friends. Because everybody brags. We all do. Social media has forced us to live a very conspicuous world, and even people who you thought were never going to talk or brag are the ones who are are always going to be doing that. They might not show it on Instagram, but there's a lot of hushed tones that get around. And it always comes back to me because somebody will say, "Hey, I met someone at this club yesterday, or over the weekend. They dropped your name. I'd like to link in with you." I'm like, "Okay," and then we'll see what happens from there. But I think when it comes down to it, is like you look at to them, quality is a sign of value, and it's a sign of a store of value. So if you own a part of an NFL team that's only gone up in value, and probably only will because of gambling now and the acceptance of that and how that's being integrated for the owner's benefit, that to them is certainty. It's a high barrier to entry, but there's certainty there. Same thing with statement class real estate, Class A real estate. If you've ever heard of the store Zara, the family office, that is one of them is based
so what I
down
find
here.
so interesting about
they
this,
deploy
just like
$2
you
billion
mentioned,
a
just to
year into
reiterate,
what they call
you're
statement
not
class
looking
assets.
for
That's
the returns.
best
In
apartment buildings,
in their paradigm,
or,
in their perspective,
Amazon
they're not looking
centers
for returns. It's more
throughout
of that
the country,
status symbol. I
because to
think you
them,
mentioned your book,
they're
kind of Trump. The
want
reason why I
to
bring up
preserve
Trump, I know
value.
he's
They're
kind
not
of
looking to get
controversial.
rich quick.
It's because
They have
everybody
$2
knows
billion.
Trump.
They
and
have
so
at
forth, but
least
he's bought obviously a
$4
lot of real
billion a
estate
year
in
that's
some
being
very
thrown
high
off
caliber
in cash that
places,
they need to
Trump
put
Towers,
somewhere.
etc.
And what they're doing is
And
they're
again,
putting
that
it
is
into
more
the
of that
world's
status
best
symbol,
real
more so
estate.
than
And
that
about
return on
85% of their portfolio is some of the world's best real
I want to
estate,
reiterate
London,
that.
New York, LA, and Miami too.
Interesting, awesome. So I want to talk a little bit about alternative investing, private equity specifically.
You have a good memory.
Mainly because
Yeah.
we're seeing a lot of, definitely
Yeah.
with these uncertain
You have a good
times.
memory. So Trump
I
was,
read an
he's
article
a
the other day on
value-added
CNBC
investor.
that
He's a
there's
New
going
York
to
City
be
developer.
several, I think
And
it's
one
almost
of the things
double
that's interesting about
trillions of
Trump is that,
dollars added
he
to the
grew up
private
as a
equity
kid
by
from Queens.
2027.
His father owned a
So a
lot
huge
of
amount of
residential
money,
stuff,
a lot of family
workforce
offices
housing,
are
and he wanted the
they're,
glory of going into
are
Manhattan, and he
outperforming
did. And the rest
institutional
is
actually
history.
in regards to deploying capital
So
in
he's a
that
perfect
direction.
example of the
Endowments
second
we're seeing,
gen, the next
large
gen,
margin of their
trying to
portfolio are
exceed,
in private equity and
the
so forth.
success
I
of
wanted to
the
get
first
your
gen.
perspective when you are working with your relationships and network, off market opportunities. What are you seeing as regards to the opportunities, pivoting away from the VC to the private equity, something a little bit more sustainable and good, internal rate of return?
Oh, yeah. I think, it's interesting. When you look at privates as a whole, when you look at venture or private equity, you have a lot of smart people who are over-allocated into this for a reason. When you look at the stock market, that's like a 60-40 rule that has been invented by the brokerages over the past 50 years to keep you invested into your 401k. And that really, mainstream advice doesn't really work for anyone with over $10 million in assets after a certain point. And what you're seeing is that the Yale endowment, for example, has 86% of their assets invested into private equity or venture. Harvard, not a slouch either, around 77%. So what does that really tell you about the smart money? And you can bet that those companies that they've invested into, much like ours, because we've co-invested with some of them, are much more higher barrier to entry, right? Like life sciences, or maybe something with AI, with a very, very, huge lead investor and a big contract with, sports teams, which is something that we've involved with. So to us, it's, the privates is where the real wealth creation is. It always has been. If you look at real estate, for example, commercial real estate, it's always gone up mostly, except for when interest rates have gone up, as we're seeing now. But it's something that is not to the whims or does not have the same risk profile as owning a bucket of common stocks that can be written down to zero by a bankruptcy judge at any given point because there was a run on your bank. Does that make sense? So these people want to get in early where they can control the terms and price, which is where the real wealth creation is, rather than not having control after the company goes public. Because there's a false sense of control with people when they say I own stocks, is that they can sell any time. Yeah, they can sell at a loss. But I also control the terms that I get into with one of these companies, and if I want more options or warrants or something like that, I can ask that. And a great example of this is like what happened in 2003 with Martha Stewart. She had a fan base of women that owned her stock, and it was almost like they had bought that stock purposely because they wanted to be a part of her, and it was like, to her, they saw her as a store of value, until she went to jail. Then the stock went down. What control did they have over that? None. Did they have old Martha's cell phone to call and complain about the stock price dropping of their 200 shares that they own? No, not at all. So you got to look at it. The middle class has that still like that scarcity mindset Whereas when you look at
So do you feel like,
the people who
because
I
I've talked
deal
to
with,
some family
they want to know
offices,
not only what
and
the risk
they
is, but
are
what are
sitting
the
on the
terms?
sideline
How are we
right now,
controlling this? What
and I've
happens if
noticed a
everything
pivot
goes bad? How
slightly
do we
toward
insulate ourselves
PE,
from the risk?
but the
And
thing is
with
they
that
don't
is
really care for
who
the
you're in bed
management
with.
fees, so
As I
they're
said
kind of
before, the cap tables
reallocating. And
sold
again, I'm
any
not saying
venture or
everyone,
private
but I'm
equity
noticing a
firm.
trend a little bit.
Same thing
I
with
wanna
real
get your
estate
opinion
too.
on
If you have a
it.
lead real estate
And they're
guy,
deploying
that's
capital
very
directly
important too.
to direct
But
investing, direct
people
deals.
feel as though
And I'm
there's
noticing that.
there's
However,
no
though, what I'm noticing
control
also potentially is
in
that there's not a
stocks.
lot
You
of
can't
infrastructure
control
that a lot of these
the price
family
or
offices
terms that you're
have
paying for
to
something
actually,
at. And I think a lot of people
underwrite,
think that just having
structure,
liquidity, which is
look at
basically a
these,
financially
deals and so
engineered
forth. So
product,
I wanted to get your opinion on that.
made
Sal.
for the common investor, is control, and it's really not. Yes, yes, yes. You're right. Yeah. That's where we come in, and that's what people, that's where the trust and the credibility is our ability to do that. With my two partners, life sciences and other industries, they have a world-class track record. With real estate, the same thing for me. The funds are, everybody comes to me, and I'll hear someone from Middle America say, I want to start a fund, and I'm like, oh, I just roll my eyes, because having had funds, they're not fun. Because especially, if you have to market them, and the real issue is, and we saw this with Tiger, and I posted this on my LinkedIn, is that once you take in a massive amount of money, you have to put that money out quickly, because you have what's called the IRR clock to your head. And so that enforces emerging managers, or managers that don't have a lot of experience, to put money out into things that they probably would not have put in the first place, just so they can show their investors that they're doing this. And the model we have, which is great, is that we make direct investments. So now you have the discretion. Maybe you don't want to invest in life sciences, Christian, but you love this AI scout company, and that's something that we've invested into, and you're very into it. That's fine. That's your discretion, and that's what families want, is discretion. They want a full understanding of it, because when you're an investment manager like us, as I said in the book, you're sort of like running like the flight control tower, right? You're guiding the planes in, making sure that the documents come in, and making sure the T's are dotted, that T's are crossed and the I's are dotted. But you're also an educator too, making sure that your investors understand the investment in a way to take the time to educate them so they feel comfortable about it. And in real estate or venture, it's where your money goes and how it comes back sometimes. This is very simple. Just because somebody has a lot of money doesn't necessarily mean they have an understanding of what IRR is. And I don't mean that to sound derogatory, but you have to sort of talk to people, and they're like, no, you don't take the IRR to the Ferrari dealership, you take the cash on cash return to the Ferrari dealership. Then they get it that way. And that that comes from years of talking to people. You just develop the relationship, but sort of the charisma around it to influence them so that they feel comfortable investing with you. But you're absolutely right. Nobody wants to get into a fund anymore, because they just see that a lot of these funds haven't performed, but they've enriched their fund managers, because when you have $1 billion in assets making 2% per year,
well, you bring
what's
up
the
such amazing
incentive
points
for
here,
that
because,
manager
like
to
you
take any
mentioned,
risk? He's just sitting
not
on
saying
the
that the PE
assets, and he's
doesn't
just
work.
going to
We're
buy a
seeing
few
that
things.
obviously effective,
And that's
but
really
there's
the
a
difference you're
misalignment
seeing
for
right
family
now with a lot
offices.
of the.
But I love how you're obviously,
It's a
Sal,
funny story,
and
but
what you
that's
guys
the
are doing at
difference
Danville
between
Partners, where
what
you
we're
guys are
doing
running point
versus what
guard,
a lot of the Sand
collaborating
Hill
with a
Road
lot of
things,
family offices.
venture,
You guys are filtering
in
these
Palo Alto and
exclusive
San
deals, right?
Francisco.
Very relational.
Those guys right now, they'll
and
invest in a
very
few deals,
exclusive
but
as well.
remember, their track
They
record
run
is
through
off of
your
something
very
that they
high
started back in
developed,
the 70s,
methodology
right?
and hurdles,
And so they're
and then
not
you
really
spit them out
they're
and say,
getting a
hey,
lot of
this is
branded
approved. It's gone through
AUM
our
coming through
very
their
strenuous,
brand,
kind
but that
of
doesn't
underwriting
necessarily mean
process,
that
and
that's
then say, hey,
correlating
this is the
performance,
opportunity, because in the family
in so many
office,
words,
doing
the
direct
term I
deals,
use in
it's
the
very
industry is that,
expensive,
a
and
lot
it's
of them are
costly
extinct
to
volcanoes right
underwrite
now.
and do all that process for them individually, correct?
Yeah. Yeah. Well, yeah, and the problem is that it's also a function of where you live. If you live in New York and you're a family office and you need to find a CIO, it's kind of easy to find someone, right? Just anyone off of like Goldman or Morgan Stanley can do that for you. However, when you're in, less disparate parts of the financial center of the world, that's where people start trusting people who they think have the skill set that don't. And they could be like a financial advisor at Raymond James. They don't know anything other than selling you a sushi menu full of stocks, right? But I can't tell you how many times I've gotten on the phone, like, I talked to my financial, okay, well, what's his background? Well, he's really good, smart. And you see him on the LinkedIn, and I'm like, no, we're not going to do this. Like, if you want to talk, that's fine. If you have someone serious who doesn't have a tribal tattoo around his arm, about this, and no offense to that, but someone who really takes this seriously as you do, I'll spend the time with it. And they're like, no. And sure enough, they'll just invest anyway. But to them, they just want to have that validation, but they don't know who to go to for that validation.
That paradigm and what you
we
guys
excel
do
pretty well with the emerging families.
Salvatore, man, I really appreciate you being on here, just unpacking your methodology, your principles,
we're not looking to
think
be
about
the
these things,
900
and the evolution of the 1% between the
but
0.001%,
we
right,
just want
and
to
their
make sure
investment
that we're
strategy
agile
and their
and we
way
can
they think about
execute,
things, and
because a lot
where
of the
they're
situations we
deploying
see
and
might
infusing
go where
capital,
elephants can't. And in
as well
private
as just
equity,
your
that's
hurdles
not so much the
in regards to
case,
qualification
because you're
deals.
dealing with bigger check
Salvatore,
sizes and
for those that
leverage
want to be,
and
like you
other
mentioned,
good
I
things
know
like that,
throughout our
because those companies are
podcast,
a
some
little
ways
more
to get
industrious
in
and,
contact with you.
further along.
How else do they
So
reach
there's
out
many
to
other
you, be
factors
part
to
of what
take
you got
into that.
going
But
on
as
if
far
you're
as what we're
qualified?
working with as it relates to venture, a lot of these families want to make direct principal investments. Mm-hmm. Thank you.
Awesome, guys. And those links will be in the description. I put all of his content down there, as well as all the other links he mentioned throughout the podcast. I'll make sure I put those in the description. So I appreciate making yourself available where you put your email down there. So I'll put his email so you can reach out to him. Guys, that is my friend, the CEO and the CIO of Dandrew Partners, the one and only Salvatore Buscemi.
They go there.
Guys, that is Journey with Christian Davis podcast. Until next time, be uncommon if you can.
Otherwise, they can send me an email direct at sal@hrn.llc. That's HRN, Harlem River Navy, hrn.llc. And if there's anything you want to talk about, let me know. We're not looking for deals right now, so don't show me any deals. But if there's anything else we need to help you with, let me know. Absolutely.